Hello everyone. This is a video on how to make money during COVID-19 and beyond. Well, first of all, if you don't know how to trade stocks, we highly recommend using Webull and Robinhood to get into investing for free.
COVID-19 has completely changed our way of life over the past few months. Over 4.6 million people have been infected, and there have been around 310,000 deaths globally. Beyond this devastating loss of life, which seemingly happened so fast, we have also seen the fastest fall into a bear market in U.S. history. It took just 16 days, starting February 19th, for the market to fall from an all-time high. The fear of contagion has shut down entire industries as well. In April, the unemployment rate in the U.S. reached 15%, the highest since the Great Depression. This next slide shows exactly how quickly the U.S. market dropped in comparison to other economic crises, such as dot-com, GFC, and the 1987 crash. Although the market may not have reached the lowest of lows as some of these other downfalls, COVID-19's effects were by far felt the quickest, dropping close to 30% in just 16 trading days. As investors, we can attempt to use historical data from some of these other economic crises that I had just mentioned to help adjust our asset allocation accordingly. It is important to ask ourselves, is this market reaction truly any different from any other historical crash? Although it may seem as such, the public and market reaction was generally the same, and that was one of fear and panic. The graph to the right shows the S&P 500 trailing price per earning ratio dating back to 1987. It notes when other significant decreases had occurred. It is important to note that every dramatic decrease is eventually followed by a correcting increase. This economic downturn is in many ways unprecedented, but we can try and use data from previous crashes to predict our economic future and create a new adjusted asset allocation that can benefit us.
We've created an asset allocation strategy that we believe would best benefit a younger investor with a long-term time horizon. Think a recent graduate or someone who's been working for just a few years and is ready to start saving for retirement. Now before we get into it, because this is a period of great uncertainty, we recommend a minimum of 3 months worth of living expenses in cash before you start investing, although 6 months would be preferable. Now, key to not just surviving this market, but profiting off it, is to stay calm, stay objective, and remember fundamentals. There doesn't have to be a drastic change in general portfolio allocation, especially in an aggressive portfolio. Think about this example from Annie Nova. She's a personal finance reporter for CNBC. If you had a portfolio worth $500,000 in February, with 70% allocated to stocks, your portfolio would have been worth less than $400,000 a month later. A month after that, in April, it would have recovered to about 94% of its original value. Had you sold when it was way down, you may have lost way more, and in fact, rebalancing at the bottom may have actually made you money. So don't panic. We recommend that 80% of your portfolio be a standard aggressive growth split. That's 80% in stocks and 20% in bonds, or if you're including your cash reserve, then 80% in stocks, 15% in bonds, and 5% cash. Historical returns from 1926 to 2018 show that a portfolio that was 80% stocks and 20% bonds would have averaged annual growth of 9.4% without active management. That time period includes the Great Depression and 14 other recessions. Now, the reason the majority of the portfolio should be almost business as usual is that, and many experts agree, we're going to see the beginnings of reversal, possibly even beginning in the third quarter of 2020. Sally Krawcheck, the former CFO of Citigroup, says that 10 to 20 years down the road, this is just going to be a blip on an upward trending chart. Analysts at Morningstar think the coronavirus will have just a 1% long-run impact on global GDP. It's important to remember that the best days often occur after the worst days in volatile markets. Starting in 1930, if an investor missed the S&P's 10 best days in each decade, total returns would be just 91%, far below the 15,000% return for investors who held steady through those downturns. This portion of the portfolio should be well diversified, but you should be careful to exclude any companies that seem like they may not make it through this current crisis. This would be a great place to get some great, enduring growth stocks at a reasonable price. Stocks like Amazon, Apple, Google, Adobe, or even Walmart. Companies that consistently grow, are large enough to weather bad times, and are still operating right now. The other portion of your portfolio, the 20%, is geared towards capitalizing on the economic repercussions of COVID-19, where there is real potential for above average growth. Money here should go towards companies you'll know will be around after the crisis, but aren't doing so well during the crisis, so they have a decent rebound growth potential. These are things like travel and even some better off oil companies. This is also the place to take bets on industries under massive pressure right now. The kinds of companies that might not make it through coronavirus, but if they do, the turnaround potential is tremendous. An example would be some very troubled airlines. This is also the place to invest in companies that benefit from COVID. Technology that flourishes under quarantine, the Zooms and Instacarts and Chegs. Lastly, close attention should be paid to small and mid-cap US equities, as these are the ones that historically outperform very early in a recovery cycle. This portion of the portfolio should be monitored, especially in the case that those companies that do well under quarantine but might see a decline once the world reopens. As the economy returns to normalcy, we suggest a shift back to a standard aggressive portfolio mix with an 80-15-5 split for stocks, bonds, and cash, having assimilated or sold that other high growth aggressive 20%.
The airline industry has seen record low numbers in share price in recent years. Air travel has dropped nearly 95% from March to April 2020, and a $2.2 trillion stimulus bill was signed by President Trump on March 27, 2020. This stimulus bill gives $25 billion in grants for airlines, $3 billion for airline contractors, $4 billion for cargo air carriers, and to qualify for this grant, airlines must employ their workers through September 30th, 2020. Many analysts predict it will take 3 to 5 years for the airline industry to fully recover back to their 2019 numbers. They also predict mergers of airlines will also take place. If analyst predictions are correct, it seems now would be a great opportunity for investors to buy airline stocks for a long-term hold at its current market price. If predictions do come true, there is a potential of 50 to 75% returns in 3 to 5 years. The casino industry is another industry hit hard due to the COVID-19 pandemic. Many major casinos have closed their doors, dropping share prices to minus 36.6% to minus 64% from last year due to quarantine laws placed in the United States. In 2018, the US gambling industry made $79.4 billion, and for many casinos, they have closed their doors for the first time in decades, with Caesars Palace in Las Vegas closing their hotels and casinos for the first time in 54 years, with only 10 states currently allowing online gambling as an alternative. Gambling is one of the most popular activities in the United States, with scratch-off tickets, casinos, and sports betting just being some examples. Like many industries, the casino industry is heavily affected by supply and demand, and an article posted by Cengage, people would not be tempted to gamble if opportunities were not so widespread. With so many casinos shut down due to the COVID-19 pandemic, it is quite obvious many people would not gamble. However, as the country slowly reopens, it may be concluded many people will go back to their old habits as gambling is seen as an irresistible temptation, which will drive up stock prices for casinos that have closed their doors.
Infrastructure is a very important part of the portfolio allocation strategy. Certain stocks and bonds in this industry can be considered an intelligent purchase during this time of COVID-19. The virus has played a major role by negatively affecting construction, manufacturing, infrastructure supply chains, and engineering. From February until now, the S&P Global Infrastructure dividend yield has jumped from 4.5% to 5.7%. The pandemic has caused stock prices to drop while dividends keep increasing. For example, you could see in this chart of NextEra that the stock price has dropped from $280 to close to $200. However, the stock has started to reverse while the dividend price has been consistently going up. Caterpillar, Nucor, Jacobs, AECOM, and D.R. Horton show similar data as this pandemic continues. The energy sector has taken a rough hit when it comes to the first 2 quarters of 2020. Politicians in the United States who feared the virus put several restrictions on companies within this particular industry. Energy stocks that are a part of the S&P 500 are down almost 50%. Oil prices per barrel have taken such a big hit that it continues to break negative records as the weeks go on. However, investors understand the energy sector plays such a big role in the global economy and employs hundreds of thousands of people. Stocks in this industry are likely to see a reversal as the virus slows down. As you can see from the graph in this slide, WTI is expected to see a sign of reversal relatively soon. The industry will then begin to see healing and consolidation.
The impacts of the coronavirus, leading to the aptly named Great Lockdown or Great Shutdown, seem to follow similar patterns to other economic downturns and market crashes that have occurred previously in our history. As such, examining historical data and these historical trends can illustrate proper investment decisions to make. To compile everything that we have discussed here, especially for younger investors with longer term time horizons, tragic events and market corrections like these are strong opportunities to translate more cash and your savings into assets and equity. Even with the unprecedented and unexpected slowdown of economic activity in the global economy, the world will start turning again. And as such, younger and new investors should view this time as an opportunity to enter the market and make smart investment decisions. In each economic downturn in our history, industries are impacted differently depending on what caused that economic shock. In 2008, the financial and real estate markets collapsed, and in the late 1990s and early 2000s, the dot-com bubble saw a large number of internet and telecom companies dissolve. As such, what an investor could end up looking for in the coronavirus recession are sectors of the economy that would be minimally affected or even benefited by the effects of the virus, such as sectors that are not very labor intensive or sectors that may make working remotely or working at home more efficient, such as teleconferencing services like Zoom or Microsoft Teams. However, for more reliable and less volatile long-term growth and capitalization strategies, sectors that are at the core of our economy are best suited for recovery, and these are the strongest options. Recall that we discussed earlier industries like airlines, energy, and infrastructure. As of now, the loss of economic activity has hit these industries hard, but as the economy opens back up, these sectors will be some of the first to start ramping up production, while also in the meantime being supplemented with federal stimulus packages.
This is a slide of all our references, and I hope you all stay healthy and safe. Thank you all for watching.